Hello and welcome. In this month's on-demand webinar, OJM Group Principal Jason O'Dell discusses 7 reasons why owners of cash value life insurance may want to consider an exchange or a refi of their existing policies to reduce costs and increase distributions. It's important to note that this video is for informational purposes only, and the information may not be suitable for your personal circumstances. Please contact a professional before attempting to execute any of these strategies. If you find this information helpful, we would encourage you to check out one of our books. OJM is pleased to announce the publication of our newest book, Wealth Management Made Simple. The authors provide answers to common questions they have heard from their work with OJM clients, topics including investment terminology, market history, tips for choosing an advisor, and more. At the end of the webinar, we'll discuss how you can get a free ebook download or a hard copy of Wealth Management Made Simple or any of our other books.
Hello, my name is Jason O'Dell. Now what I want to talk about is a concept, refinancing life insurance. As I relate that to refinancing your mortgage, I'm sure a lot of you have refinanced your mortgage over the last 10 years. I know I have, and I know a lot of our OJM clients have, because we've seen mortgage interest rates drop significantly and really even fall below what they were prior to the financial crisis. The concept's simple. You refinance your mortgage if the savings interest over the time outweighs the cost of doing a refinance. Pretty simple, right? What I want to cover today is applying that exact same concept to another asset I own and that many of you own, permanent cash value life insurance. Both life insurance and real estate are governed by 2 different sections of the Internal Revenue Code that allow for a tax-free like-kind exchange. Most people are very familiar with the real estate version of this code, which is 1031. Most people, though, are not familiar with Section 1035, which covers life insurance. Reason this is important is this Section 1035 allows us to take existing policies that have cash value and move them directly over into a new policy, not triggering any tax consequences. This is the main starting point of why you would want to consider doing this type of refinancing on an existing permanent life insurance policy, is because there wouldn't be any tax consequences if you structured it properly. We have about 7 reasons that I'm going to cover with you today on why looking at a refinance exchange of a cash value permanent life insurance policy may make sense to you. What we've seen is a reduction in industry-wide cost of insurance charges. What we know now is that people live longer due to advances in medicine, technology. The life expectancy of individuals is far greater today than it was just 10, 15, and 20 years ago. Because of this, insurance companies have lowered their cost of insurance charges. So it is definitely worth taking advantage of these reductions in their cost of insurance charges. Also, if you're still in excellent health, you're going to be able to lock into rates today based on your health classification. And if it's the same as it was when you bought the policy, you lock in a new lower rate of cost of insurance charges for the life of the policy, thus saving you tens, if not hundreds of thousands of dollars in expenses. Also, what we've seen is that the costs from insurance companies in their policies differ because they not only have cost of insurance, but they also have other pricing expenses in their policies. And what we've seen is carriers have lowered those. Some have increased them. And by looking at today's products that are available to you, you may be able to find a reduction in their other costs inside their products, which would be advantageous for you to take advantage of. Another reason would be because accessing the cash value in your policy, if that is one of the strategies, by pulling money out of the cash value, we see that the rates for accessing this value, these cash values are dramatically different. What we do know is they can range anywhere from 0.25% to 8%. So just imagine 2 individuals that have $500,000 of cash value in their policies, and they want to take a stream of income from it now that they're retired. One's paying 0.25% interest to get to the cash value, and the other is paying 8%, 32 times greater than the first individual. Think of how much less the second individual will be able to pull out of the policy because of that 8% interest charge. Recently, we wrote an article on this particular topic, and I'm happy to share that article with any of you who are interested. Just contact me. Another reason is looking at mutual companies. Mutual insurance companies are owned by the policyholders. That is different than a stock company, which is owned by shareholders or stockholders of that particular company. If a stock company has a profitability, they return that to the shareholders. If a mutual company has a profitability, they return that back to the policyholders. And one such carrier that we worked with over the last 30 years has had 28 times they have reduced their cost of insurance charges on their products because of the profitability of the company. That's pretty amazing savings that they pass directly on to the policyholders. Also, looking at maybe taking advantage of some of the new features that policies offer today. A lot of policies today now have features that have long-term care riders on them, benefit distribution riders in the event someone gets ill and they want to access not only their cash value, but some of their death benefit prior to dying. There are riders and features now available that weren't around 5, 10, 15 years ago. So it is advantageous to at least have your current policy examined for whether or not it has any of these riders, or if it doesn't, are there policies out there that have riders that would be advantageous for you to take advantage of. Finally, one of the thoughts behind looking at if you own an existing whole life contract is that we have seen the dividend crediting in whole life insurance policies drop steadily since 1990. The chart to your right shows the dividend crediting rate for those various insurance companies. And I know this chart's busy, but what you'll see is that since 1990 to 2017, we've seen a dramatic reduction in dividend crediting, a downward sloping graph here. May make sense at this time to look at refinancing or restructuring a whole life contract to some other type of policy that's out there. Now let's look at an example of this. We have Bert, who is a 40-year-old individual when he purchased a whole life policy from a very well-known, highly rated insurance company. Today he's 52 years of age, and he was curious about how does this refinancing structure work, or how would it work for me? We looked at what rate classification did Bert have when he got it. He was super preferred. Today he's still in excellent health at 52, and he's able to get that same preferred rating. Because he's able to get that same preferred rating, if we were to take his existing whole life policy and use 1035 section of the code and move the cash value over to a universal life policy, and we were to assume that he could earn a 5.85% rate of return in that new universal life policy, as well as the same 5.85% rate of return in his existing whole life, what would the distributions from each of those look like? Well, the distribution from the whole life policy would be $53,696 for a 20-year period of time, starting at age 65. If he looks at the new universal life policy, he'd be able to get $98,000, a little over $98,000 out for that same 20-year period of time. That's almost a $45,000 improvement, or $900,000 improvement over that 20-year period of time. This dramatic improvement is due mainly to two factors. One, the likely improvement in the cost of insurance charges from the whole life product to the universal life, but also the improved cost of accessing the cash values in the universal life insurance policy versus the whole life policy. I strongly encourage any of you that are out there to take advantage of looking at, if you own a permanent life insurance policy, take advantage of looking at what are the products and features that are available today that may not have been available to you at the time that you purchased them. You should at least look at your options. But remember, when you look at these options, this is a complex strategy that needs to be done by someone who has an expertise and a knowledge in this particular area. You need to consult your advisor before you'd ever consider making a decision about doing this. Here at OJM Group, we work with physicians in a number of different ways. I covered just one of those today, life insurance. However, we have experts that have MBAs, that are attorneys, CPAs, and certified financial planners that work in all these different areas to help our clients understand what are the best tools, strategies, and techniques that are available to them as it relates to their financial situation. I appreciate your time today. Thanks for watching.
OJM is a multidisciplinary wealth management firm, and we have worked with over 1,000 clients throughout the country. We work in 3 different divisions for our clients: wealth management, consulting, and insurance benefits. We would welcome the opportunity to speak with you about how we might be able to bring value to your wealth planning. As I mentioned at the beginning of the webinar, our principals have authored several books, all of which are available to webinar viewers at no charge. You can get a free hard copy or ebook download for Kindle or iPad by visiting ojmbookstore.com and entering the code OJMWEB at checkout. In addition to a free book, OJM Group also offers webinar viewers a complimentary consultation where we can answer your questions and see if our firm might be a good fit for your situation. Visit ojmgroup.com or call 877-656-4362 to schedule your free consultation. Enjoy the free copies of our books, and we hope to have the opportunity to speak with you soon.